Hello, Vikram.
Sir, I'm not able to share the screen right now.
Just a sec. Shruti, are you able to do now?
Sir, just a minute. Yes, sir, I'm able to share the screen. I'll just share, huh, sir, once. Can you see my screen, sir?
Yeah. Zoom, no? Put some other this thing presentation. Can you change the tab, Shruti? Yeah, I can see. Yeah, I can see.
Okay, sir. So, sir, I'll just back up a little bit on how we started and where we started. So, as you know, Dr. Haresh Tolia, sir, is into practice into stock market since last more than 35 years. And sir is voluntarily teaching all the students about financial literacy, how they can invest their money smartly since last 10 years. But during this COVID time, sir thought of starting a group of not students, doctors, like people from different various background. And we started online classes in July 2020. And since today, every week we are conducting one or two classes. And that is where concept learning and workshops and just hands-on practice, and everyone is just learning in the group. And that is very kind of sir that he is doing all this voluntary and on pro bono basis. And today, like I was one of the students who joined in 2020, and I was totally new to this concept. And today I can say that at least I know good fundamental analysis, basics of fundamental and as well as technical. So this is just a little bit of background of how we started and where we started. They say a journey of 1,000 miles begin with a single step, and we are glad that today many of you, as we have been told, that are new to stock market and they are entering into stock market for the first time. So we are grateful that we got an opportunity to start with their journey with the fundamental analysis, like knowing the right basics first and then investing your money. So when it comes to basics, a little bit of background that stock market is not just about uh, पैसा दिया इसमें डाला और कल double हो गया. It's not like that. It's about understanding the economy, relating to the type of sectors that are there in the economy. So you can see here that these are the different sectors in 2020 and 2022 and how they perform. So each and every sector, like there is a cycle of which sector is running at which moment. So as a new person or as a any professional who is entering into stock market, we should try to get acquainted with the economy first. What is there? Like we know, like even I'm from an engineering background. This all was very new to me, finance and how it is done. But slowly and slowly, as sir started teaching us, it was important to understand which sectors are running, which companies into which sector, why those sectors are not running right now. So those basics are important to learn. Second most important basic thing is emotion. Like in stock market, like the fundamental thing that sir always taught us is control your emotions. There is nothing like FOMO in stock market. People were earning where the Sensex was 9,000, and people are still earning when the Sensex is 18,000. And I think that will continue when Sensex will reach 36,000. I mean Nifty. So basically, there is no like आप रह गए मैं रह गया ऐसा कुछ नहीं है. But it's very important to control the emotions and especially go with the flow, but with your basics. So like sir always taught us that when there is a depression, like people are losing money, so you should be with a good fundamental stocks, ready with your fundamental stocks in such a way, then when market is down, you should be happy and you should start like you should carry a basket of stocks and you should go for a shopping कि आज मुझे कौन सा stock खरीदना है करके, because market is down and you are getting it at a very good price. So those things we learned during the journey. And if I talk about my journey, I saw my portfolio going in red, in negative, and today it's again in green and in with good percentage like in good returns, I would say. So
Shruti,
it's all
can you
about.
increase the size of this thing slides? It's looking very small.
So okay, it's not in the presentation mode.
Yeah. It's in presentation, but the size. Yeah. Okay, now perfect.
Now it's fine. Okay,
Yeah.
okay. So it's very important that how we control our emotions. Like even if your entire portfolio is red, but you know that you have invested in the fundamentally good stocks, then you can be relaxed and you know that this will pick up and it will give you good returns in future. Just a minute. Okay. So, fundamental, what is basically in fundamental, like how you should start your fundamental analysis. So, basically, it's a very simple question. Company क्या करती है? Without knowing the basics of the company, one should never invest in that company. That is what we have been told, like on the first day of the learnings, that without like आपको पता ही नहीं है कि कंपनी का प्रोडक्ट क्या है, कंपनी के promoters कौन है, कितने promoters ने कितना अपना पैसा डाला है. Without knowing such basics, you cannot invest in that particular stock. So fundamental starts with this basic questions. And in this, sir gave us his classic example to us, that when sir started investing in Astral Pipe, that was 12 rupees per share. Sir, basically, he went into the market, he went to hardware store, he asked people कि भाई आपका क्या response है, ये कितनी पाइप बिकती है, इसका response कैसा आया है customer से. So he did that survey. Is After that he got assurance that okay, this products of this company are good, and that is how he started investing in that company. So that was a classic example that sir gave us. And today I'm implementing that example whenever if I see any product with it's from a listed company, then I'll definitely try. I'll definitely see, and then if I'll see if I want to invest in that company. So, like, what are the products or services? When the company started, what was the business like year, like the year it got listed, and उसके पहले कितने साल business में थी company? Who are the promoters, investors? Who are the directors? Where company is located? Like the geographic region of the company also matters a lot. Like Tata Steel in Jamshedpur, it's a very sweet spot for steel company because they have iron ores in that area. So company kahan located hai is like, like in COVID times, supply chain was hampered a lot. So in case if a company is located in such a remote place, uski supply chain disrupt ho jayegi and raw material ही नहीं पहुंच पाएगा. So then of course company will not be able to give good profit and sales. So we should know all these things before investing in a company. This is something sir always taught us in terms of for especially for doctors group, that fundamental analysis is basically knowing the symptoms. He just the basic symptoms of the patient, and then you go into technical analysis, that is basically like an X-ray or ECG. So this is what sir always said. I think this is the best way to explain all the doctors. Why fundamental analysis is important. We won't go directly for an X-ray or MRI. First, we will understand the basic symptoms of the patient. So that is basically in a very simple language, the difference between fundamental and technical analysis. So as Vikram sir mentioned, we have curated 5 series of lecture, in which today, as I said, this is the introduction, and followed with this, my colleague Dhruv will take some of the terminologies which are important to understand before entering into fundamental analysis. Then in the next lecture, we'll understand some of the like we'll have an introduction to fundamental analysis, where we will understand the pyramid structure, in which hierarchy, which parameters have to be seen for a company, for a good fundamental company. Then which are the other factors for fundamental analysis, some of the rules of the market, like trend is the friend, and there are a couple of rules that we will discuss, and some of the economic, industrial, and company analysis parameters, like on which basis one should analyze a company or the industry in which the company is running. And last not the least, the phases of the market, like it's a bull phase, bear phase. So there are different 6 phases, euphoria phase. So all those phases, and in each phase, how investor reacts, how retailers react, how traders react, or how a common people who don't have knowledge about stock market, how they will react. They will give you tips. In euphoria, there will be a lot of IPOs. So you'll come to know that market is in euphoria. So all those things we'll discuss in the next class. Then we have a session on criteria for selecting a fundamental good stock. So you'll be wondering on which basis we should select a stock. So we have some parameters, like suppose ROE. So it should be greater than 25%. ROEC should be greater than 30%. So like all those criterias we have, and that is of course based on all the knowledge and the years of experience that sir has gained, and he's sharing that with us like a treasure box. So we are very grateful that we are able to, we don't have to spend so many years in learning such things, and sir is just sharing with us. So all those criteria, and like when to enter, when to exit such fundamentally good stocks, so we'll learn that in the third session. Then we have annual reports. So when it comes to like I said, right, अगर ITC company है, we can try ITC, some of the ITC products and all. Bata है, Bata के products से पता चल जाता है. But there are some companies we don't use their products directly. Some specialty chemical companies, pharmaceutical companies, we don't use their products. So in that case, reading some of the aspects of annual reports are important, and that will be taught by one of our team members, that how to read such a long annual report very quickly and easily. Then we have last session on screeners, like after putting all these criteria, how we will screen the good stocks. So there are multiple screeners that are available. So we will be using it, like we'll be sharing it how to use the screeners. So this is how we have curated for 5 session series, so that towards the end of the session you will be in a position that you'll know how to pick, what to pick, on what criteria to pick, and from where you have to go and pick. So at least this much you will be able to do it yourself. So today I have with me my colleague Dhruv. So I'll just I'll give an introduction about Dhruv. He is 23 years old. Like he was the youngest person when he joined our group. He was 21, and he was doing his economic graduation at that time. And today he has been associated with us since 2 years. Dhruv has taken a lot of workshops and sessions with us, and today he is working as a derivative trader with an hedge fund. So I'll request Drew to please introduce your slide. And in case of any queries, after the session, of course, we have Q&A. But in case if you have any other queries after the session, we are happy to address you anytime, and you can shoot an email to us on this email ID. We'll share this in the group also. So thank you. That's it from my end. And I request Dhruv to please take over. Dhruv? Just got. Hello, Dhruv?
Yeah, I just a sec, Dhruv. I need to unmute you. Unmute you. I just find out. I really. Okay. Dhruv's profile. Dhruv, can you start your video? I can't see Dhruv actually. Okay.
Hello.
Dhruv, can you hear me now?
Yeah.
Yeah.
Yes, sir. Yes, sir. Thank you. Thank you, Shruti. Yeah. Okay. Let me share my screen first. Okay. Hope you can see my screen. Hello.
Yeah, we it's loading.
Okay. I think there is a net connectivity issue.
Yeah, now I can see.
Okay. Yeah. So good evening, everyone.
Yes, Dhruv, again this thing presentation is not seen. Just showing loading.
Okay. 1 second. 1 second.
Yeah, now we can see. This is fine. I think we can start this way.
But the slideshow won't work. The screen is still it's loading, sir.
Yes, yes.
Okay. I think there is a issue with the Google Slides. Okay, no issues. We can
we can do it this way only. You need to click individual slide then.
Yeah, I have to, but I had put that animations and all, but that's fine. We can do it this way. Yeah. So good evening all. Let's start with the session. So before starting, thank you Shruti for the introduction. And I would like to start by thanking Haresh sir for teaching, guiding and training me to this level that I am able to present this presentation to all of you and share the knowledge which he has taught us. So let's start. I will be covering the basic of the stock market, which are the ratio analysis. So let's start with the first slide. So before we go to ratio analysis, there are basic 3 questions which we need to ask. What is ratio analysis, why it is important, and how to apply? Okay, so why we need to know this is, if we know the foundations well, it will be easy for us to understand how the ratios are working. Coming to the first question, What is ratio analysis? Basically, what is ratio analysis? It helps us to determine the company's performance. Now, the company's performance includes a lot of things. Few examples are there: the company's liquidity, profitability, operational efficiency, etc. Now, this is a quantitative method. We know that the ratios are in form of a data. So it is a quantitative method which helps us to understand how the company is performing within the competitors in the market and so on. The second thing is why ratio analysis is important. Now, we know that the company's information can be in a lot of different ways, a lot of complicated terms. But ratios, as I told, it is a data format. It simplifies the data into small financial ratios, which are like operational efficiency, financial efficiency, long-term positions, debt, equity, etc. Now, why they are helpful? We can judge a company easily with that particular data and not by the long lengthy form of the
Dhruv, we can't hear you.
hello.
Yeah, now
Hello,
it's
hello,
yeah, yeah.
hello. Yeah, okay. So I was telling that this data helps us to judge the financial performance of a company, but in a quicker way. And we can use this to compare the company with its peers and the industry average. Okay. Now, how to use it and how to apply it. Now, when we go to the application of ratio analysis, each and every person thinks that what are the hot ratios or the holy grail which I can apply and take my portfolio to the next level, right? So whenever we go, here is a small screenshot. I hope it is very minute, but please, these are the amount of ratios which are available on the Screener website. Screener website will be discussed in the coming lectures. So these are the ratios which are available on the Screener website. So how a introductory person or when a person enters to learn the ratios can determine that what ratios are important and what should be learned. So here we take the quote of a very famous person, we all know him, that I never invest in anything that I don't understand. So first we will try to understand the few basic ratios which are the foundation for fundamental analysis, and these are the 6 ratios which we will discuss today. Okay, these are the face value, earning per share, price to earning, debt to equity, return on equity, and return on capital employed. Okay, now coming to the first one, face value. Now, what is the face value? Nowadays, we don't have the physical shares with us. Whenever we purchase a share, it is directly converted to our demat account. We don't get the physical copy of the shares. But previously, when we used to get that, we had the share certificate which had the original value of the share price. So there the face value was mentioned. Now basic information about this is the formula, which is equity capital is equal to face value into number of shares. This is just for information purpose. This is not going to be used repeatedly, but we need to know this. And the face value will not change unless the stock splits. We have heard sometimes that the stock has split. For example, right now, Tata Steel, the stock was split and the rate came down from around 1200 to around 190 rupees, around that. Okay, so whenever the split comes, the face value of the stock changes. Okay, the second one is earning per share. Now, this is a basic formula about earning per share. It is that the company's net income divided by the outstanding shares the company has. Okay, the total income of the company, the net income of the company, which is divided by the total number of shares the company has. Okay, so this is a formula which we need to know to implement how earning per share is has to be evaluated. Now, why this is important? See, we judge a company or do a research about a company based on the results the company gives, the performance of the company. Now, how we judge the performance? It is either on quarter basis. We all know every 3 months the company publishes its results, and on annual basis. So for both the things, earning per share gives us a better idea that what the company is giving me for my one share. I have bought one share of, let's say, Reliance, then what the Reliance company is earning for me for that one share. Okay. So this is where earning per share comes into place. The next slide. Okay. Yeah. The third ratio is the price to earning ratio. Now here, there are two concepts. One, the price per share, and E stands for the earning per share. Okay, now earning per share we just understood, and price per share we know. We will understand this, the P with an example. That, for example, the earning per share is 10. This is the just an example, the outstanding, the net income and the outstanding. This is an example of earning per share. And to get the price to earning, we divide earning per share and price per share. That is 10 divided that the market price, which is 100. Therefore, 100 divided by 10 is 10. Now, what this says is the investors are ready to pay 10 times than the market value for the company's share. That means the company has a value which investors have put, which is tenfold times than the current market price. Okay, so this is just a basic introduction. There are multiple factors related to this. Slowly and gradually, we will get to that in the coming lectures. Okay, now how do we interpret this price to earning ratio? One, if the price to earning is lower, the company is good. Why? It is simple that if the price to earning is low, there is a gap that the price can go up because we are getting the company at a lower price where the investors are still not ready to pay more for that company's market price. And the opposite is higher PE means the stock is expensive. That is, the stock price is less, but the stock price is more, but the PE is less. Now, these are both contradictory statements, but you can't follow the statements blindly. There are multiple factors related to it because different sectors, different industries have different types of PE. So whenever we are doing a research about the company, we need to compare it with its peers and not with the intersector. We have to compare the steel sector with the steel companies. That Tata Steel can be compared with JSW Steel. You can't compare Tata Steel with Reliance. Okay, and you have to compare with the industry PE. There is a concept known as industry PE, which calculates the average PE of the industry, which helps us to determine whether the stock is expensive or cheap. Okay, I hope all of you are following what I am saying. If you need me to slow down or do something else, please let me know. Okay, we can, before going to the next ratio, we will see this this example. Yeah, so here you can see that there are two companies, company one and company two. The first principle is the capital required for both the companies is 1000 crores to run the business. Okay, so first we will see company one. Company one has equity with itself, that if I am starting a business, I have 500 crores in my hand, but I need 1000 crores. So what I am doing, I am taking a debt of 500 crores at 14% interest rate from the market. Okay, now let's assume that on 1000 crores total, I am making a profit of 200 crores in a particular annual year. Now, first of all, what I have to do, I have to repay the loan, but we will just include the interest over here. We are not getting to the principal amount. So here 14% comes to 70 crores. Okay. So what is the profit here? The profit is 200 minus 70, which comes to 130 crores. Okay, now there is a formula that is ROE. This is a ratio. We will come to it in the next slide. But what is ROE? ROE is 26%. I will share the formula in the next slide, but you just keep in mind what I am trying to explain you. Company 1's ROE is 26%. Company 2, your company has whole 100 crores in its hand. So there is no need to take any debt. We are assuming that the company 2 is making the same profit, that is 200 crores. But here we are not paying any type of interest, and the net profit is 200 crores. Okay. But here you can see, even though we have not taken the debt, the ROE has been reduced to 20%. Now, why this is important, we will see in the next one. This is a very important ratio, which is debt to equity. Now, the basic formula for debt to equity is total debt divided by total equity. And the debt includes both the debts, long-term and the short-term debt. Now, why we are considering debt a important ratio is that whenever there are crises or bad economic conditions, the companies which are having debt, they have to pay the tax. They can't, the interest. So they can't get through the interest part if their business is not in a good shape. So whenever the company is in bad time, and if the company has more debt compared to the equity, here we are comparing debt to equity. So if the company has more debt compared to the equity, then there are chances that the performance of the company can fall. Now, high debt companies and low debt companies, we can't mix both together. High debt companies are, we can see the example, power company, bank, etc. And low debt companies are retail sector, software, etc. Now, particular sectors have different type of debt structure in their company. So whenever we are doing a research, we have to do a research based on the sector, based on the industry, not inter-industry, that we are comparing steel industry with oil industry and etc. Now, the ideal debt to equity ratios are mentioned here. If the debt to equity ratio is less than 0.3%, all these ratios will be mentioned in the screener section part of the lecture. I am just giving a basic introduction to debt to equity. So if it is less than 0.3, then it is very good. We can consider investing. If it is between zero point 0.3 to 1, we have to examine whether the company has a history of high debt and all. And if it is above 1, we should avoid investing. We should study that why the company has taken debt, what are the prospects of taking the debt, and then we can go ahead. Okay. So now coming to the next slide. Return on equity. Now, here in the debt to equity, I had given a table which had return on equity. We are going to discuss about this indicator or ratio. So this is a profitability ratio. Now you can see that this is the basic formula how the return on equity is calculated. It is equity share capital. That is the initial capital by the promoters who are starting the business, that is known as the equity share capital, plus the reserves and surplus. For example, if I'm starting a business, I might have some savings, some reserves from my previous business or before starting the business. So that is considered in this. The preferred equity, which we take from the families, friends, and relatives, and the debt which we take from the market, like banks and all. Okay. So here we are taking an example that, for example, we need capital of 4 crores to run our business. Now, 1 crore I have with me, which is saved. 50 lakhs is from the reserve surpluses, which I have saved for my business. 50 lakhs I am taking as a preferred equity at the rate 15% interest, and 2 crores I am taking debt from the market, which is around 10% interest rate. Okay. So the basic formula for return on equity is PAT, that is profit after tax divided by total equity. Okay. We will understand this with an example. Let's assume that the company has made a profit. Now this is earnings before interest and tax. Okay, so it has made a profit of 80 lakhs. The number one thing which the company has to do is to pay the debt, the interest on the debt. So we are deducting the interest. We had taken 2 crores, so 10% is 20 lakhs. Now profit after tax comes to 60 lakhs. Now, sorry, before tax comes to 60 lakhs. After that, we have to pay the tax, which has 30. Here we have, for simple calculation, taken 30%. It differs from the business to business, 30%. So it comes to 18 lakhs, and the profit after tax comes to 42 lakhs. Okay, this is a basic calculation how we come to profit after tax, which is required for the formula. Now we get the return on equity, that is 42 lakhs divided by 200. We knew that 4 crores were required. 2 crores are with us, including preferred equity, and 2 crores we had taken debt. So here the total equity will only include 2 crores, and we will not include the debt part. I will explain you how this can be good or bad in the next slide. But the return on equity ratio comes to 21%. Okay. Now we know that the company has taken a debt, but here the company is not including the debt part in the return on equity ratio. Now, how this can hamper our thinking that yes, it has a good return on equity ratio, we can invest. It is about 20. Let's assume if the ratio is about 15, we can invest. This is an example. So if we see it is about 15, it is 21, we can invest. But we don't know that the company has equal amount of debt for the total equity it is holding. How this can mislead us, we can see in the next example. Okay. So here we have taken two capital structure companies. The one capital structure company is 50-50%. That is 2 crores equity, 2 crores debt. And the second structure is 25 and 75. That is 1 crore equity and 3 crores debt. Both require 4 crores. So we have divided one in 50-50 and the next one in 25-75%. Now we will compare the both in good and bad economic terms. What happens to them? We have taken the same example from the previous one where we came to 42 lakhs as the capital, the profit after tax. Now we will compare this good capital structure with this the capital structure to in the good economy. We assume the profit is same, but here the taxes and the interest will be more because the debt is 3 crores. So the 10% tax comes to 30 lakhs. Profit before tax comes to 50 lakhs, 80 minus 30. Tax comes to 15 lakhs as the profit is less compared to the capital structure one company. And the profit after tax is 35 lakhs. Here you can see the tax is the profit after tax is 7 lakhs less compared to this company, the capital structure one company. But below we can see that the return on equity of capital structure one company is 21. But here, because the denominator, which is the total equity, is less, this is a misleading indicator just for this reason that it shows us 35% return on equity because the debt over here is 75% and the capital with the company is 25%. So here we can see that 35% seems that the company is making good return on the equity, but when the reality hits, that is in the bad economic situation. Now let's assume in the bad economic situation, the company's profit drops from 80 lakhs to 25 lakhs. Now the interest would be same. There is no discount in the interest because of the bad economic condition. So it comes to 20 lakhs. Still the capital structure one company is profitable. So at least the company will survive at that time and the return on equity will be minutely positive, but there will be a return on the equity. But we can see if the debt is more than the equity, you can see in the profit before tax, the company has started making a loss. So there is no question of tax or profit. So at that time, the 35% return on equity ratio directly drops to a negative ratio. This is how, if we only use a one ratio to determine the financial stability of the company, it will mislead us. And for that reason, we have a next ratio, which is return on capital employed. Now, what this ratio does is it includes all the types of capital that the company has employed in the business, including the debt. Okay. So here we can see the liabilities are also taken into consideration. And this is the basic formula, which is equity share capital, reserves and surplus, preferred equity, as well as the current and the non-current liabilities. Now, current non-current liabilities are basically the debt, which include the short-term debt and the long-term debt. Now, there are multiple formulas to carry out this return on capital employed ratio. I have taken a basic formula, which is profit divided by the capital employed. And here we are taking the profit before deducting the interest and taxes. We can also use after deducting the taxes and the interest rate. Okay. So this is a very basic formula where you can use return on capital employed, and compared to return on equity, this ratio will give us a wholesome view that what the company is generating for the whole capital it has invested in the business. So along with all these five ratios, if we are getting yes in maximum ratios, then we can consider that yes, we can go ahead and start investing in this company. And this is a basic scenario where you can learn all these ratios and try to understand the company's financial stability and the company's prospects. So this was part from me. Thank you so much. If you have any doubts or any queries.
Yeah, the group is open for questions. If you have
Yeah.
any questions, any member has any queries, you can ask both the presenters today, and Dhruv as well as Shruti madam. I'll unmute just a sec, or you can type the question also. You can unmute yourself if you want to ask question.
Dhruv, we have a question.
Yeah.
ROE, yeah, equity, return on
Okay.
equity.
I will share my screen again. 1 second. Yeah. Yeah. So this is the formula. Return on equity, the formula is profit after tax divided by total equity. Here we can see the total equity consists the equity share capital, reserves and surplus, and preferred equity. We don't consider debt in return on equity. So we are only taking the 200 lakhs, that is 2 crores.
Can you please share the next slide?
This one?
Yeah.
Yeah.
Okay, so in this the debt is 300. Yeah, fine. So ROEs will consider only 100 in the capital structure 2.
Yes. Because we are only considering the return, the total equity here.
Not debt.
Yeah, not debt.
Yeah, anybody on YouTube wants to ask, they can type. I'll share the questions with presenters. We have around 40 people watching from YouTube also.
Dhruv, there is a question on ROCE with an example.
Okay. So here we can take the same example of this. Profit after tax is 42 lakhs, and here for ROC we can take the whole 4 crores. that is 2 crores total equity and 2 crores debt. So 42 lakhs divided by 4 crores. That will come to the ROCE.
So basically, you mean to say ROE gives you an idea about what is earned by, say, equity holders, while
Yes.
ROCE gives an idea about what is earned by everybody,
Yeah.
including the
No. Not equity holders. See, one thing here you can see the priority. Whenever the company takes a debt or doesn't take a debt, that is a second question. But the priority comes debt, the interest should be paid. Second, the tax. Third, the preferred equity. And fourth, the common equity. So whenever we are saying this, it doesn't mean that the people who are investing will earn more. It is the company which has the equity in his hand and the debt. Now, in ROE, they are not considering the debt to calculate the return. But in return on capital employed, they are considering the whole capital, that even if I have taken the debt, they are considering that debt and then calculating the return, that how much they are making on it.
Dhruv, what is the difference between ROIC and ROCE? Are they same?
ROIC,
Return on invested capital.
no, sir. I think ROIC is a different concept.
Okay. If there are no more queries, okay. What is the best source of getting all this information for companies? I think Screener is the best one.
Yes, screener.in.
Yes, sir.
That will be covered in the.
So in the next lectures, we will be using Screener. So members can actually download screener.in and see the various parameters given there, so that they get very well used to it. And whenever the presentation is done here, so they'll not find it very new. So just check on Screener. You can check big companies like Reliance, TCS. Just have a fair idea, and then any which ways we'll have this experts giving their presentation.
Dhruv, we have a question for
Hmm.
debt to equity in banking sector. So I think
Yeah.
we discussed this, that usually this will be high because banks have more loans. So
Yes. Yes.
so in banking sector, how debt to equity ratio can be used? I think that is what the question
See,
pertains to.
yeah. Whenever you are using the ratio, you know that the banking sector has high debt to equity ratio. So you have to compare it with its peers. See, there is HDFC Bank, ICICI Bank, Axis Bank, Kotak Bank. Let's take the four example. Now, whenever you are comparing, you can see whose debt to equity is more and whose debt to equity is less. And along with that, you can take all the other five ratios, that how the company is making quarter on quarter, that is earning per share, how it is increasing, it is decreasing, what the return has been generated on the capital employed. So along with the debt to equity, if you accumulate all the other five ratios, then you will get to know a better idea that which company is better combining all the six ratios.
Okay, there is a query on our WhatsApp, that can you please mention above which level we should consider a share good for all parameters? Probably we'll be discussing that.
Yes, we will be discussing that in the screener section, because right now, if I tell, it will be too much
Yeah.
to get through, sir.
Yeah.
Because all the parameters are joined to each other, and I just shared example for that in the debt to equity slide. I will show that again. See, if the debt to equity is less than 0.3, it is good to invest. Between 0.3 and 1, we have to examine. This was just an example. It will be shared and discussed in the coming lectures, sir.
I think Bhavesh bhai, we have answered your question. Bhavesh Desai had asked that question.
Sir, I have one direct question about the next lecture. I can't give the answer, like I'm not able to get the person's name, but yeah, so next next Thursday. So all the lectures we have scheduled on Thursdays, and I'll share the schedule with sir, and sir can share with everyone.
Yeah, there is a very good message. Any preparation to be done from our side for next lecture? I think that's very nice.
Uh, sir, we'll think about this and we'll let you know, sir. That's a
Sir,
really
sir,
nice question.
you all can make notes if you
Yeah,
Sir,
want
can I
and
say
ask
something?
the doubts in the next lecture.
absolutely. They should make notes so that the
Yeah,
concentration is also there and they'll remember better. And one more thing, we will try and upload this whole talk of 45 minutes on YouTube in case it has been recorded. I don't know if it is recording or not. I've tried to record it, but that will, after the session ends, we'll come to know if the recording was there or not.
Sir, can I talk something?
Yes,
Sir,
sir,
yeah,
please go
Haresh,
ahead,
sir.
sir. You need not ask also.
Sir, if somebody is new, very new, then iTribe is a good app which you can download from Google Play, and everything is explained in that how to go about. You can go to the learn part
Which app?
and iTribe.
I track. Right.
I will
Yeah, you somebody can type it.
I've sent it in the
I
chat box.
tribe.
I
Okay,
Yes,
tribe.
okay. Yeah.
iTribe.
TRIBE.
Hmm.
And eLearn is another one.
Dhruv,
Dhruv, please
please
type
type that also.
Yes.
eLearn also. These two apps are good for learning. You have to go to the learn session of the app, and one by one you can go through the videos over there. So there are very basic videos in that, and this all these terminologies are explained in that. So if somebody wants to do homework, they can do this as a homework.
Yep. And I think on Zerodha also university, they have done a very good job there. So Zerodha Varsity, there is a fundamental section, there is a technical section. If people want to know, they can go to Varsity. There is a app, proper app from Zerodha like Coin and Kite. There is one more app called Varsity. So you can just go visit Varsity and you can find basics. As sir told, iTribe also you can try, and e-learn markets.
E-learn market is also a very good one,
Right.
and different types of things are given over there. It is for, say, if a teenager is learning or a beginner is learning, and if somebody wants to learn fundamental, different videos are given there for fundamentals, different videos are given for technicals, and option and future also they have shown videos where we can learn. And I always refer to Investopedia for all my uh, queries.
Yeah.
Investopedia is a good site.
Yeah.
And second best site is Wikipedia. So
Yes.
out of these two sites, I don't go out anywhere to find any queries which I have to deal with. These two are enough. They will give you all the answers.
iTribe is a website or an app, sir?
It is an app, Google Plays the app, you can download it.
Okay, sir. There is a
And
query
Sir,
on
you can
WhatsApp.
also follow iTribe on Instagram. Those who are on Instagram, there is its page iTribe. You can follow that.
Okay. So, sir, probably next time we'll give them some preparatory notes so that next time when we have a talk, they can just read little bit basics and come, I think.
yeah. I would like to know how much they already know, how many people are totally new beginners and they absolutely want to learn everything from beginning. See, if we can separate out these two people, then it will be very good. Like if there are beginners, let us take them for 4 sessions, and after that we can add on some other people who have some knowledge.
Right. Probably we'll
We are going for beginners only.
Yeah, this is absolutely for beginners, and probably we'll do a poll tomorrow or day after, and we'll just find out how many people want to start with so much basics, or if they a majority people are very familiar with this, then probably we'll go to little advanced.
Yes.
Okay, then there are no more queries. Thank you very much, all the presenters and sir. Let's meet on next Thursday. In between, we'll share all the topics that we'll be having on next Thursday. Thank you very much and good night.
Thank you,
you, sir.
everybody.
Thank you, sir.
Meeting ID would be same for next Thursday.
Yes, it will be for all the meetings the same ID. We have bought this Zoom premium version, so it will be same.
Thank you very much.
Yeah, thank you.
Thank
Thank
you,
you
sir.
very much, sir. Thank you very much.
Yeah, good night.
Thanks a lot, sir.
Thank you. Thanks a lot, everyone.
Thank you.